All right. Good morning, everybody. Today is Thursday, May 5th. Happy Cinco de Mayo. It was a happy May 4th yesterday for markets after Jay Powell came on and talked, and we'll talk a lot about that today. But I wanted to get started off with Shopify down 12%. Again, we've talked about ad nauseum these pandemic stocks really getting hit on earnings. The outlook was not as good as expected. Basically, a lot of people who are shopping on e-commerce are now shopping in person, and that's causing a lot of these highly valued pandemic plays who didn't adjust to a more brick and mortar, more normal reality. They're starting to take it on the chin. Shopify's down 12%. We have a couple others that we'll talk about toward the end today that are getting hit as well, or have been hit over the last few days. It is good. It is a good day. If you are planning a wedding in the UK, the British pound is down another 2% this morning. The Bank of England met today. They decided not to hike by 75 basis points, and the pound is getting pounded today. It's down to 123. There was times just not too long ago when the pound was $1.60. It cost $1.60 to buy a pound. This time last year it was about $1.45. In September, you're looking at about $1.35, and now it's $1.23. So the pound is really dramatically depreciated against the US dollar, which is good if you want to visit the UK. It's bad if you're trying to sell to the British, because all of our American goods are going to look more expensive. But getting to the action of the day, the market was about neutral heading into the Fed meeting yesterday. We got the press release. The press release was difficult to discern. There was a significant amount of market volatility around that number. We went up to positive 0.8% and then down to negative 0.5%. And then when Jay Powell began to talk, we started to really begin to ramp up in terms of the S&P 500 and the markets overall. So Tom, why don't you talk a little bit about what the Fed did and then what they said, and then we can kind of talk into what the meaning behind the words was.
Yeah, so as expected, we saw a 50 basis point rate increase on the federal funds rate. What we did not expect is that the runoff on the market or on the balance sheet was going to start below the initial signal level. So they had initially signaled that when they began to run off the balance sheet that they were going to do $60 billion in treasuries and $35 billion in mortgage backs. But when the release came out, they actually decided to do half of that proportionally to begin, and then eventually ramp up to the $95 billion in 3 months starting on September 1st. And so we're going to see $30 billion in treasuries and $17.5 billion of mortgage backs run off. And so the initial reaction was, this is kind of dovish. It's not super dovish. Everything is kind of the same. And then once we rolled into the actual speaking portion, when Jay Powell was taking questions, he was pressed on whether or not that 75 basis points was the target for the next rate increase, which is in the middle of June. And he basically said that that's off the table. He said they're not seriously contemplating 3 hikes, within the month. And so that was really I think the linchpin in terms of what set the market off on an upward trajectory, was that not only were they coming in a little bit short on the runoff, but they were also basically saying, we're not going to go guns blazing in the next month. So if you look at how the futures changed in terms of expected rate hikes, the number has not changed, but the cadence has. And so right now we're signaling definitely 2 hikes in a month, and then an additional 2 hikes after that. And then from there, it looks like we're slowing to about 1 rate hike till the end of the year. And so the futures projection is about 10.7 for the year, which is down slightly from the peak. But, I think that if we go 2 and then 2 and then 1 for the remaining 4, we'll end up at 10. And that seems to be the bogey, would be my guess. And so, even though futures are indicating, closer to 11, I would think that 10 is probably the number for the year, at least at the pace that we're seeing right now. Obviously, inflation is going to play into that. They basically said they're going to continue to do 50 basis points until they see progress on PCE inflation. And they think that it's going to be moderating and get back on track. They reiterated that they're trying to shoot for 2%, and that that's the goal they're going to get back to. I think that's, how long that's going to take is going to be very difficult to suss out. but we're probably going to end up somewhere in the 2 to 2.5% range on the federal funds rate by the end of the year. And then that's really going to be where we're at. That's kind of the projection. And so obviously things can change, but that's the course we're set on as of the meeting yesterday.
Yeah, I think there are a couple things from that. I think that bottom line is the talk has been tougher than the action up till now. And I think that this was a good reminder of that the talk has been extremely tough, but then it sets the stage for being able to not have to do as much when that time actually comes. What's interesting to me is that I do think that the 11 that the market is pricing in makes some sense, because while if we play it out, the 10 does look like that's what the Fed is planning on right now. I do think there's an upside skew to that. So on a weighted average basis, I think 11 makes sense. And that's what markets do. They try to price in those probabilities. But I think 10 would be my base case, and as it is for the Feds. Now, let's get a little bit into what Powell said. So he said that he does expect job creation will slow, given monetary policy, healing in the labor market, and supply and demand will come back into balance and wages will moderate. So basically what he's saying is that we're operating at 110% of capacity as an economy. This is causing inflation and overheating. Think about just running your car at 4,000 RPMs the entire time. Yeah, you can go a bit faster, but eventually you're going to overheat. The Fed doesn't control supply, so it can't just build a bigger engine. That's not what the Fed does, but it can slow the car down and make sure that you can run at a more sustainable rate. So that's what Powell's trying to do. So he's trying to get that car from going at 110% of capacity to go to 100% of capacity. And he's going to try to do that by slowing the car down. The key is don't slow the car down too much, where you start to get rear-ended by other vehicles. So it's a very delicate balancing act, especially when you consider the fact that monetary policy acts on a lag. But that's basically what Powell's view is. Now, the question to you, Tom, then is, how do you interpret this? A, do you think Powell can be successful with this strategy? And B, what does this mean for markets going forward?
I think it can be successful. I think that the question is, are they going to go too far, too fast? And I think that's basically what he's setting the table for today, or yesterday, was that, everyone's anticipating a hard stomp on the brake. And then he's basically saying, we're going to stomp hard, but not that hard. And I think that, there's probably going to be a situation where someone like Jim Bullard comes out and says, we're raising 15 times. We're actually going to do a 1% increase in July. And that signaling is going to cause more damage than the actual moves. And so they can continue to slow the market with talk of doing things. And then that kind of puts them in a position where they don't actually have to do as much. And that's sort of the way I would think about it. I do worry that they're putting themselves in another credibility conundrum because he was asked he basically said in his statement, we're willing to do whatever it takes to bring inflation down. No matter what it takes, we're going to go as hard as possible. And then, the next question was, well, will you do 3 rate hikes next month? And he's like, yeah, probably not, which is like, we're going to do anything to end World War II. It's like, you're going to drop the bomb on Japan. He's like, I don't think so. It's like, maybe dual sanctions like Russia, that's kind of where he was. And so that starts to be, where the signaling gets a little bit confusing, I think, to people is, are we really going to go as hard as we need to do it? Or are we going to take measured steps and it's going to take a lot longer to wrap up? And I think that, based on how they acted during COVID, where they basically turned the tap on and fired everything they had at saving the economy, I think it's definitely a potential that they could do the exact opposite, which is, turn the tap off and fire into every tool they have to stop inflation, which could be pretty tough for people in the short term. But I think ultimately it's probably the right decision.
Yeah, I would characterize yesterday as kind of a relief rally that we saw in the markets. I think that with the tough talk, people were really concerned, ourselves included, of what the Fed was going to do and what Powell was going to do. He's been pretty merciless over the last few months in terms of how he's interacted with markets. And so that was the fear coming in. And he seemed to have a little bit more graciousness, a little bit more understanding of what that means. And I think it's clear he doesn't want to go into recession if he can avoid it. I think that he's going to try. Inflation is a priority, so he needs to take that down. But he's going to do his best to not to take a recession, which kind of it makes common sense. But I think that there were a lot of people thinking that he would be so austere, that he would be a Paul Volcker and really try to break the economy and basically put leeches on the economy.
Yeah.
And I think he's actually trying to treat it with medicine versus leeches.
I mean, he made a statement, and we don't have the exact quote in front of us, but basically he was saying that it's an unhealthy environment to have 2 jobs open for every person that's unemployed, and he can't make more people to fill those jobs. But what he can do is enact pain on companies to make them not have those job openings anymore. And we already saw that. Yeah. So we saw Facebook say they're putting a kibosh on any hiring for the rest of the year. You know, that's going to have a net effect on the open jobs number. You know, that probably will either go down, they'll probably close any open jobs they have, you know, out there that are being counted, or they're not going to add any additional going forward, which should bring that number down.
Yep. I think if you're looking at a longer term view on how does the market tenor change as a result of this, I think that you have a little bit more confidence in Powell. He's going to be still looking at inflation as the target, but it's not like he wants stocks down at any cost. So at the end of the day, the Fed is tightening policy. That's go into a slowing economy. The economy is slowing and the Fed is tightening policy. That's not a great recipe for economic growth. However, I would say that the contraction is relatively shallow. It's probably necessary because we don't want that car to overheat. And I think that if you look at if inflation does begin to moderate, as we expect, as the Fed expects, and the Fed pulls off on some of these rate increases in the back half of the year, instead of doing 50 basis points every meeting, doing to 25 basis points, as he said yesterday, then in going into the fall, you have a few positive tailwinds. One is you have very easy comparison periods because last year we were dealing with Delta and Omicron and all of that. Number 2 is you have somewhat less hawkish, not dovish, but less hawkish monetary policy. And you also have easier comparisons from the supply chain. So I think that you could create a narrative where there is some more positive reasons to be more positive going into the back half of the year. I think that probably doesn't happen maybe until even after the election. The election may actually pause some of that stuff. But my point being, I expect the contraction, to the extent that it occurs in the economy, to be relatively shallow, supported by very strong balance sheets of companies, very strong checking accounts and savings accounts for consumers, and still positive demand. Shifting gears a little bit, we talked about Shopify at the beginning of the show this morning. Lyft, just wanted to hit on that really quick. That's down 30% yesterday. Very weak outlook for the second quarter, and primarily on the cost side. Although everything's opening up, what we're finding is in this sharing economy, you know, when people were just trying to find a buck, they were willing to do drive for Lyft, do Uber Eats, drive for DoorDash. Doctors were willing to see patients on Teladoc. All of the supply of that type of labor is really drying up, and Lyft was down 30% yesterday because they have to increase spending on driver incentives just to get people on it. And what happens if they increase spending on driver incentives? Either number 1, they have to charge a lot more for that service, or number 2, they jeopardize their profitability. Tom, any thoughts on this and the sustainability of a lot of these sharing economy apps as businesses?
I mean, I think it's just a change back to normal. And I think that even pre-COVID, you know, driving Uber was a great gig because you could be flexible, right? But now there are a lot of companies that are letting you be flexible anyway. And so we may not have overcorrected all the way back to everyone's in the office every day of the week. But if you were someone who drove Lyft or drove Uber for the flexibility of it, you know, now it's like, man, I got to wear a mask. I got to worry about getting sick. I got to be in front of all these people. Everybody's unhappy with the situation. Like, it would probably be better to go work an office job where you could work 2 or 3 days from home and have some of that flexibility, but not all of it, but make more money, have more stability, and not have to deal, you know, with all of the hoops you have to jump through to be a Lyft driver right now.
You don't have fuel costs, insurance costs, accident.
Yeah, exactly. Yeah. And the cost of doing it has gone up so much in a very short period of time.
And the comparison with that, I mean, you can go get a retail job. I mean, there's 7.2% job openings in retail. We saw that number on Tuesday. So there are a lot of job openings in that business, and you're getting $20 an hour starting at Lululemon.
Yeah, I mean, we went to Bucky's in Leeds, Alabama, on our way to Birmingham last Friday, and they had a big sign up. It was like, you can work here at this, the world's most elaborate gas station and make $20 an hour easy. That seems like a pretty sweet gig rather than driving Uber all day, and maybe eking out $20 an hour during perhaps peak hours on the weekend. Taking people home from the bars at 1 o'clock in the morning would be your best bet for making good money, and that's kind of a grind, I would imagine, versus hanging out at a gas station that everybody loves.
Yeah, I would agree. On that note, we're going to end it there. We'll see you tomorrow. Tomorrow's jobs day, so please be here. We're going to be doing the jobs number live, talking about the Fed reaction, talking about what sectors of the economy are seeing growth. It's going to be a really busy morning. It's really busy week this week for economic data in the Federal Reserve, and it's not slowing down tomorrow. So please be here. Have a great and safe Cinco de Mayo, and we'll see you here tomorrow.